Welcome back to Compounding with Callie, where I take my dog Callie on runs and talk about anything investing, budgeting, and all things personal finance. So let's compound some miles and our money. Today we're talking about one of the most underrated tools in investing, especially if market ups and downs stress you out, and that's dollar cost averaging. This is one of those concepts that sounds simple, but when you really understand it, it can completely change how you invest and how you feel about the stock market. By the end of this video, you'll understand what dollar cost averaging is, how often you can use it, why it works historically, and how it can even help you if you want to take risk with individual stocks without letting emotions run the show. Let's start with the problem most investors face: emotions. When the market is up, people feel confident and want to invest more. When the market is down, fear kicks in and people freeze or sell. That emotional cycle is one of the biggest reasons investors underperform the market over time. Dollar cost averaging exists to solve that exact problem. At its core, dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. You don't try to time the bottom, you don't wait for the perfect moment, you just invest consistently. Weekly, bi-weekly, monthly, whatever fits your life. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this averages out your cost and removes emotion from the decision-making process. Let's make this real. Say you invest $500 every month into the market. In January, the price is high, so you buy fewer shares. In March, the market dips, and that same $500 buys more shares. In September, prices drop again, and you buy even more shares. You didn't need to predict anything. You just stayed consistent. Over time, that consistency works in your favor. One of the biggest advantages to dollar cost averaging is flexibility. You can do it weekly, bi-weekly, monthly, or even quarterly. If you get paid every 2 weeks, you can invest every paycheck. This is the way I personally invest. The Monday after my Friday paycheck, I have an auto transfer to my personal brokerage account. This allows me to have funds available on a regular schedule to invest, and it makes it so I can't spend any extra money that my budget allocated for investing. If monthly feels easier, that works too. The frequency matters less than the consistency. The goal is to make investing automatic, boring, and repeatable, because boring investing tends to win. Now let's talk about performance, because this is where people get skeptical. Historically, dollar cost averaging has produced strong long-term returns, especially in volatile markets. Over long periods, the stock market has averaged around 7 to 10% annual returns depending on inflation adjustments. Investors who consistently invested through downturns instead of trying to avoid them ended up with better outcomes than those who waited for better conditions. The market rewards patience and consistency, not perfection. This also brings up an important comparison: dollar cost averaging versus investing one lump sum once a year. On paper, lump sum investing can outperform if you invest at exactly the right time. But here's the problem: almost no one does that consistently. If you invest once a year and happen to buy near a market peak, your entire year's contribution is exposed to that timing risk. Dollar cost averaging spreads that risk across the entire year. Some buys will be high, some low, but overall you reduce the chance of making one really bad decision at the wrong time. And for most people, dollar cost averaging simply matches how money comes in anyway. You're not sitting on piles of cash waiting to invest. You're investing from your paycheck. That makes DCA not just effective, but realistic. Now let's zoom out and talk about the future value of the strategy using the rule of 72. The rule of 72 is a simple way to estimate how long it takes your money to double. You take 72 and you divide it by your annual rate of return. So if your investments grow at 8% per year, 72 divided by 8 means your money doubles roughly every 9 years. That means if you're consistently dollar cost averaging into the market and earning around 8%, the money you invest today could double multiple times over in a few decades. A dollar invested in your 20s could double in your 30s, again in your 40s, and potentially again in your 50s. That's the compounding effect dollar cost averaging helps unlock, because it keeps you invested long enough for time to do the heavy lifting. And here's a follow-up on the rule of 72 that really brings it home. The rule of 72 isn't just a neat mental trick. It shows you how much return rate matters. If your portfolio grows at 8% annually, your money doubles every 9 years. But what if you could get a little bit more, say 10% annually? Then it takes about 7.2 years to double. That's almost 2 extra years of growth each doubling cycle. So imagine you start with $10,000 and don't add anything else. At 8%, you double to 20,000 in about 9 years, 40,000 in about 18 years, and over 80,000 in about 27 years. But at 10%, your money would double in a little over 7 years. So by year 28, you'd be past $160,000. That's twice what you have at 8% just from getting that slightly higher average return over decades. This is why even a small difference in annual return can have a huge effect over long time horizons, not just in theory, but in real investing. And speaking of real investing, let's look at how the S&P 500 actually performed over a recent 5-year stretch from 2020 through 2025. Using total return data, which includes price change plus reinvested dividends, the S&P 500 returned roughly 18.4% in 2020, 28.7% in 2021, negative 18% in 2022, 26.3% in 2023, 25% in 2024, and 17.9% in 2025. That's a wide range of annual results. Some big years up, one down year, but over that full 5-year period, the total return in the S&P 500 was right around 110% overall. What does that mean? A $10,000 investment held through that period would have grown to about $21,000 just by staying invested every year and reinvesting the dividends, despite the volatility along the way. That's a very real thing dollar cost averaging leans into, staying in the market through both the highs and the lows. You don't have to guess the exact best day to buy or sell. Time in the market matters more than timing the market. Now let's talk about risk, because this is where dollar cost averaging really shines, especially with individual stocks. A lot of people want to invest in single companies, and that's fine, but it comes with more volatility. Instead of dumping all your money into one stock at one price, you can dollar cost average into it over time. Let's say you believe in a company long term, but the stock price is all over the place. Instead of investing $6,000 all at once, you invest $500 a month for a year. If the stock drops, you're buying more shares at lower prices. If it rises, you're still building your position. This reduces the risk of bad timing and gives you flexibility if your thesis changes. Dollar cost averaging doesn't eliminate risk, but it does manage it. It gives you time to react, adjust, and stay rational instead of emotional. And that's incredibly powerful, especially in markets that move fast and headlines that move faster. At the end of the day, dollar cost averaging is about control. You can't control the market, but you can control your behavior. You can control your consistency. You can control how often you invest and how you react to volatility. This strategy turns investing from an emotional roller coaster into a system you can stick with for decades. So if you're just getting started, or if the market swings make you nervous, DCA is one of the best tools you can use. It keeps you invested, keeps you disciplined, and it gives compounding the time it needs to work. If you like this video, hit subscribe. I post simple, practical investing content every single week to help build a life of financial freedom. Thanks for tuning in. Same pace next time. Keep compounding.